What do Toyota shares, Bitcoin, oil, and foreign exchange markets have in common? They all obey the same mathematical law when they are bought or sold in large quantities. This empirical law describes how prices vary according to the amount negotiated. Before continuing, I invite you to subscribe and give like to this video, so you can be aware of more interesting content on economics and finance. In December 2025, researchers Yuki Sato and Kiyoshi Kanazawa published a definitive proof of the law of the square root of price impact. They analyzed millions of transactions on the Tokyo Stock Exchange for 8 years, an unprecedented achievement in the field of econophysics. This law provides that the price of an asset does not change proportionally to the quantity purchased or sold. For example, if you buy 1% of the daily volume of a share, your price will move by 10%. But if you purchase 4%, the price will only move by 20%. For years, this phenomenon had been documented, but it had not been proven as a universal law. Previous studies were based on partial data and failed to demonstrate the consistency of the phenomenon in large markets. The progress of Sato and Kanazawa shows that the law is systematically enforced for more than 2,000 shares and 1,200 individual operators, making the law a firm candidate to be considered a universal rule of market behavior. For their study, the researchers used a dataset from the Japan Exchange Group, which included all purchase and sale orders, allowing them to reconstruct the behavior of each operator over time. They identified the meta-orders, large transactions that investors divide into small orders so as not to alter the market. By studying their impact, you can measure how the negotiated volume affects the price accurately. The finding is summed up in an equation that describes how the price of a financial asset changes when it is purchased or sold. The key is that the impact of the price does not grow proportionally to the volume, but more slowly. Sato and Kanazawa refuted previous theories that tried to explain the impact of the price. Their study showed that the behavior observed in the market does not depend on particular factors, which reinforces the idea of a universal phenomenon. This discovery has important implications for the design of models that foresee market movements and improve investment algorithms. Understanding how small decisions affect prices is crucial to avoid financial crises.